Hey, it's Nathan with options4l.com. In this video, I'm going to talk about rolling single leg options. So this is rolling like a put or a call or a short put or a short call. And so we're going to go over it in this video. We'll go over a little definition of what rolling an option means. And then we'll go over Robinhood and I'll show you a few different ways that you can roll your options and also show you how to do it in Robinhood Legend. So let's go ahead and get into it. So what does rolling an option mean? Rolling simply means closing one option position and opening a new one in the same underlying asset, usually in one order. So you do the closing and the opening in the same order. So for example, you could buy to close an old short call and sell to open a new short call at a different strike and or expiration. And the same idea for spreads, iron condors, etc. So those are multi-leg option strategies, and I'll have another video on rolling those multi-leg option strategies. So check on that if you are looking for rolling spreads or iron condors, etc. So why would you roll instead of just close out of your trade? So common reasons is more time. You roll out to a later expiration date, like if you still like the trade, like you think that the stock is going to go up or down depending on the strategy that you're performing, and you think it just needs a little bit more time in order to come through and do what you expect it to do. Lets you adjust the strikes and or risk. You can roll up or down to move strikes closer or further from the stock. You can defend a tested side, so in spreads or iron condors, you adjust the untested side to collect more credit and prove break evens. And again, there'll be another video on rolling multi-leg options. And also, the common reason is just to keep the strategy going. So you take profit on a near max winner, reopen a similar trade just further out. So maybe you have like 3 days left to expiration and you're like 95% profitable at this point in time. Instead of just closing out your position, you just roll it out or roll it up or roll it down depending on, again, what type of trade or strategy you're doing. So a few key things to watch. So net credit or debit. Ideally, you roll in your style, so for a net credit, that improves break evens. And then your risk after the roll, so you got to watch your width of spreads, your max loss, where your short strike sits now. So, just being generally aware of where you're rolling to, as that's where your new position is. And then a thesis check, so if I didn't already have this trade, would I open this new rolled position? And if not, maybe you should just call it quits and close out the trade even at a loss instead of rolling for it. Like they say, never try and catch a falling knife. But of course, do your own research. This is your trading and you can handle it however you want. So that's it at a high level. Rolling is equal to reshaping an existing trade by moving time strikes instead of closing and walking away. So let's head over to Robinhood and go through a few different examples. So I have this trade right here. I have an IBIT $59 put. I have 10 sells, so I have 10 short puts on the IBIT 59 strike expiring November 21st, so about 10 days from now. And if I scroll down here, you can see that IBIT has come down lower than $59. So it is now in the money for the person that purchased that put option from me, which isn't really good for me because that means that they would go ahead and exercise that option and I would have to buy IBIT at $59, even though at the market it's selling at $58.72. Now, it's not a big gap right now, as it's like 29 cents per share. But as a reminder, it's 100 shares per option contract, and I also have 10 put options out there. So it does start to add up really quickly, and right now it's at about $300 that I'm currently at risk of losing. So let's go and look at this real quick. And so now I'm looking at my option right here, and we can see this option right here, roll this position. So Robinhood makes it very easy to roll single leg positions because they basically set it up for you. So we can roll this position, and basically what it did was it brought me to a date further out. So my current expiration date is November 21st. It brought me a week out to November 28th. So it added time. So it added extrinsic value because there's more time in that option. And so that way I can likely collect more premium the further I go out in time. And so let's look around here. So we can see the current price of the stock is $58.67. And my current strike price is the $59 put. So we got 59. So on this particular example, I probably do want to roll down maybe to the 58 if I think that the share's, going to be above $58 come November 28th, so 17 days from now. So maybe my thesis is that it's just kind of dipping down, but it's going to bounce and bounce really well. And so maybe I just roll it down to the 58. In some instances, you might just roll it out. You might not roll it down. So I could go ahead and select this strike at 59. Of course, that still puts me at risk because the trade is in the money for the person that I sold the put option to, and they could exercise it at any time. They could exercise it early, and I'd be forced to buy IBIT at $59 no matter what the share price is. Now, more than likely, someone's not going to exercise their option, 17 days early, but there is a risk of early exercising of options, so it's something to be mindful of. I have had options get exercised early, and it has hurt. I'm going to make another video on a lesson learned there because I lost about $5,000 basically overnight because the stock gapped down in the morning and somebody exercised their option, and I was forced to buy it at a price much higher than it was currently sitting on the market. So anyway, let's say I want to go ahead and roll to a strike that is still out of the money. So there's a $58 strike, and we can see it's $1.83. So if I add it to my order, you can see that it's going to close my current position. So it's going to buy 10 to close, and then it's going to do a new position, $58 strike put, and I'm selling to open. In this particular trade, I am making 1 cent per share, which brings my credit to $10. So it's better than paying a debit, and just like that, it went down to $0. So I'm basically breaking even. I'm adding a week to my trade, and I'm also lowering my strike price by $1 if I was to do this particular trade. Now, typically, I want to roll for a credit, so I might go out another week and see where we're sitting. So here I can see that I have a $58.50 strike, I have a $58 strike, I have a $57.50 strike, and I have a $57 strike, and they'll all provide a credit higher than my $1.85 it'll take me to close out. Now this one's only 3 cents, so I'd only get a credit of $30. But it also adds another week to my position, and it also brings the strike price down $2 more. Now if I didn't want to do that, I could untick that, and let's say I just want to roll down $1, and you can see right here, I'd buy back my 59 strike put that has a 11/21 expiration, and then I'd sell the 58 put with the the December 5th expiration. And you can see I make a pretty decent credit right here. And I'm also adding 14 days to my particular trade. So this might be a trade worth taking. Again, assuming my general thesis is that the IBIT ETF is going to bounce back up and be above the $58 strike price on December 5th. So that's one way you can go ahead and roll options. You just go to your particular option and you click on roll option. Another way is to actually go to the option chain itself, and you can manually construct these rolls. And this is what you would do on a multi-leg option strategy. So let's go ahead and do that real quick. So I could come to IBIT here, and I'm going to trade IBIT options, and I need to go to my particular expiration date. So I had the November 21 expiration, and right now I want to look at buying a put option because I need to buy back my current short put. So let's find that one, and you can see that Robinhood has it marked here, so you can see that I have 10 short puts right here on the $59 strike price. So I'd go ahead and add that to my order as I want to go ahead and buy that back. And then I could go ahead and change my expiration date. We found December 5th to be a good date. And in this case, I want to go ahead and sell a put. So we wanted to sell the 58. I'll add that to my order. And then I can go ahead and click on continue here. And I had 10 contracts that I was shorting, so I could go ahead and type in the 10 right there. And then I would go ahead and review my order. And we can see the order summary then. So I'm going to buy to close that $59 put with the November 21 expiration. And I'm going to sell to open the $58 put with the December 5th expiration. And I would go ahead and click submit. So that's how you could manually roll your options. And again, that's what you'll do on the multi-leg options. But let me hop over to Robinhood Legend real quick, and we'll walk through the process together there as well. All right, so here I am looking at my options chain, and I got to go to where my contracts are currently sitting. So November 21st, we'll open that up right there. We can see on the put side, I have 10 short puts on the $59 strike price, and in this case I am buying it back. So we'll go ahead and click on the ask side because we are buying, so 10, and then I could go ahead and go roll out. So I'm rolling out in time to a different date, and then I want to roll down as well because I'm rolling down in price, and we said we like that $58 strike. And in this case, we are selling to open, so we want to click the red button here, the bid, because we're selling, we're shorting the 58 strike price, and we can go ahead and update our quantity then. And also, a good point here is maybe you want to roll out like half of your contracts. You could go ahead and set up half doing it this method. So in my case, I could do 5 of 10 available, or I could do all 10 and just roll the entire trade out and down. and we can see that my estimated credit is $439.15. So that's how I could go ahead and roll my position out and down using Robinhood Legend. And real quick before I end this video, I wanted to point out that the same concept applies with rolling out calls or short calls. So I have this position right here. And so if I wanted to roll out my call position, I could roll this position. And in this case, I have an expiration date that is a week beyond my current expiration date. And I'd want to roll out and up for a call. And this particular trade is looking pretty good for me so far. As we saw, IBIT is down to like 58.60 something, and I only got a few days left. And my call strike price is $62.50. So in this particular case, I'm going to roll out and down a little bit probably. So I'll look for the 0.2 delta. There's still 62.50. Maybe I could roll to the 62 and collect a little bit more premium. And so I could go ahead and add that to my order. So I am closing my current position, which has a November 14th expiration date, 62.50 strike price. And I'd be buying to close those 17 contracts. And I'd open up a new position then with an expiration a week further out. And I would lower my strike down by 50 cents. And so my net credit would be 46 cents, or total credit would be $782 if I wanted to take on that trade. So I just wanted to show you same concept when rolling call options as it is with put options. And so that's it for this video. Hopefully you found it helpful. If you did, I appreciate your likes, comments, subscribes, anything like that. And I hope you have a great rest of the day.